Yes, I'm trying to record. Tell them to join us so that they partake of this. Even if they'll be joining from under a tree, as long as they have the connection, it will be fine. Well, I say there is that first topic, which is financial institutions and markets. And that topic majorly deals with the definitions. What is a financial institution? What is a market? What is a financial system? And much of this you're able to read and read further details like what is cross-border listing, what is a CDS account, what is a job, a bull, when you say the market is bearish or is bullish, and all those things, you'll have them in topic 1. I'll not take you back there. There are important things that we need to understand, and I felt I need to make a presentation of what we have in chapter 2. Chapter 2, financial intermediaries. Now, we start talking about that concept of financial mobilization. And please be alerting me. By the way, I've not muted you. If you got a challenge, just speak out, switch on your mic, rather unmute, speak, and then we'll be able to proceed. Now, financial mobilization. A financial mobilization, you can have money in people's pockets, and you can have money within the financial system. In a well-organized economy, in a developed economic system, you'd expect much of the money to be within the financial system. Like you'd have the money in your M-Pesa, you'd have the money in your bank account or such. But back in the day,
I'll stay as long as
mute, please. So I'm saying some days back, and some people are still there, especially in informal settlements and rural areas, they would have all their money in the hard form, in the currency form. And the money circulates in that form whereby it comes from your pocket, moves to the other person's pocket. From your pocket to the shopkeeper's till. Then the shopkeeper goes to the other person to buy goods. And the money really never gets to the financial system. Financial mobilization is actually that aspect of making money to be mobile by moving it from outside the financial system to the financial system. There are advantages of doing that. As we say, money should be mobile. Money should have that velocity, should be moving very fast from you to me, to the next person, and so forth. So financial mobilization actually deals with that aspect of making money more mobile, and making money more mobile is actually having it within the financial system. Why do we say it is more mobile when it is within the financial system? Because the money that is in your pocket right now is not accessible to me. I cannot access it unless I come to borrow you, which would be a very difficult task. But if it is within the bank, it is accessible to me. I can borrow it. And we see that financial mobilization is really important for the sake of the economy. Now, financial intermediaries play in that space. And that's why we need to consider what these financial intermediaries, which are basically institutions, do. Financial intermediaries. So you will allow me to start sharing a screen. Just a minute. You can tell me whether you can see my screen.
Yes, you can see it.
Thank you. Okay. And in case I had not introduced myself, and of course, you know me, you have my name on Moodle and all that. But this is my name, Faustin Mwinzi, faustin@kca.ac.ke, and then you have my phone number. And down there's something that I'm doing in taxation. And now that we are not in a tax class, let us not dwell in that. But I do some stuff. I have that website that is known as TaxDom. If you have interest in tax, you can go ahead and Google. By the way, it was so important that we meet for this tutorial because some years back, around 2013, 2012, when we introduced distance learning, we were just posting notes, no interaction with students, and we were not so used to the system. So even uploading that photo so that the students can see you, we were not doing that. So students were just seeing that the lecturer is Faustin Mwinzi. And for some reason, so many of them are thinking that Faustin is a lady. And it happens to so many people, they'll come around looking for, you just imagine, who is this person teaching the unit? So it actually serves purpose for us to be here today, first of all, to know each other. So we are going to look at the concept of financial intermediation. And from the word intermediation, we get that word intermediary. From the word intermediation, we get intermediary. Intermediary, I think the root word is middle. Should come from the word middle, a person who comes in between. Now, want you to see this. As we have this discussion, I want us to understand that in the financial system, we have two key players, and these are borrowers, and on the other side, we have lenders. These lenders are those who have more than they need. We call them surplus economic units, and the borrowers are deficit economic units. The issue with money is actually between the surplus economic units and the deficit economic units. So if you are in deficit and another person is in surplus, what you need to do is come together so that you help each other. And who is helping the other? It is actually the surplus unit to lend the money to the deficit. But the deficit will pay with some return on top of it. So that way it would also be helping the surplus one. So they'll kind of look for each other. It is necessary for the lenders and the borrowers to meet so that they intermediate that gap. That one is in surplus while the other is in deficit. So they may do this through what we call the direct channel. Here is the direct channel, that one. The direct channel is, it means that if I need 10,000 shillings and I suspect that you could be having 10,000 shillings, means that I come to you, I approach you as my friend, or we approach each other directly, and we settle a deal where we would help each other, help that deficit, bridge that deficit. Now, that is known as the direct channel. In the discussion that we are going to have, we'll be looking at the alternative to the direct channel, which is this indirect route. Indirect route looks like this. We have the surplus units who come in here and are invited by the body that is known as financial intermediary. They give up the surplus funds, and the surplus funds are exchanged with a security. A security is like a commitment, a guarantee, like what you get from a bank when you deposit your money. You get some, whether it is psychological comfort or whatever it is, but in reality it works, that you still have that money, the promise that the bank gives you, you have the money. So that is a security that you have. You'd have it in form of an account. Now, the bank will take that money, combine it with some more and some more money, and that money will eventually be transferred to these deficit economic units. To these deficit economic units, they take the money that is actually coming here. The bank and other financial intermediaries will know what to do, will know how to do some magic to ensure that the money moves from the deficit and gets to the, and rather gets from the surplus and moves from the deficit surplus and eventually gets to the deficit units. The banks will do so, and that will be the basis of our discussion. They'll have to get some securities. The bank, the financial intermediaries, on this side, they get some securities. Securities are promises. From the people that you have given these funds. So in which form? Like a debenture is a promise. Like a loan agreement is a promise that this guy is going to pay. Like shares, when this guy gives you shares in their company, that is a security. So that's why we have a security here. A security on this side will take the form, security on this side will take the form of shares, debentures, loans, mortgages, and so forth. On this side, there are securities that are given to these guys who have surplus funds, and this would be in form of savings accounts and so forth. Now, I want us to understand this. As we are going to look at the economic functions of these financial intermediaries, will be contrasting the direct channel, this one over here, the direct financing channel, that one, versus the indirect. How do they compare? And actually we'll be looking at the advantages of the indirect channel because it's the most viable over the direct, the advantages of that. Now, you need to carry the previous slide in mind to understand this. I'd explained that here you have these liabilities and assets. These are the securities that the borrowers have offered: bonds, commercial papers, mortgages, loans, and all this. On this side, there are liabilities, current accounts, term deposits, call deposits, and so forth. They are using their own terms. Term deposit locally is fixed deposit. Core deposit is savings account. Current accounts, sometimes they'll call them checkable deposits because you write a check against that. So while assets and liabilities, these are assets to the financial intermediaries, and on the other side, these are liabilities to the financial intermediary. Do you know that these would actually be assets? The current accounts, when they come here, they're actually assets. The current account that the lender has, because by depositing your money in the financial institution, you become a lender. That amount we are depositing to you is an asset. To the financial institution, it is a liability. Those who have the accounting background, and I suspect that many of us here have that background, to the lender, you have an asset, which is a liability to the bank. And on the other side, where the borrower is, the borrower will have a liability. Like when you take a mortgage, or when you issue a bank, not bank, when you issue a debenture, you have a liability, you assume liability. That liability in form of mortgage is actually an asset to the bank. And that is what we are trying to explain over here. So we can proceed and look at economic functions of financial intermediaries. And if you got a question, any question before I proceed?
No.
Okay, let me proceed. The economic functions, what role do they serve in the economic system? The first and very important role is actually facilitation of flow of funds. They facilitate flow of funds from deficit units to surplus, from surplus units to deficit units. That is important. One, there are people who need this money for trade. By the way, when we say that there are deficit units and surplus units, if we look at it in terms of the rich and the poor, where do you think the poor belong? Are they deficit economic units or they are surplus? The poor and the rich. Who do you think is a deficit economic unit? Would you place the poor are what?
The poor are deficit and the rich are surplus.
Okay, let's use these terms. Lenders and borrowers. Who do you think is lender and who is borrower?
Surplus is lender, borrower is deficit.
That is clear here. I want rich and poor.
The poor are the borrowers and the rich are the lenders.
The rich are the lenders. Eh? Now, that would be the obvious thinking, but you'll be surprised that it's the other way around. These rich guys borrow a lot. These rich guys borrow a lot. These poor guys have a lot of surplus. It's very little. You are like today is tarehe ngapi? Today is 10th. And you are paid your salary some 10 days ago. That means you still have some money that you are going to spend for the next 20 days. I'm not saying that you are poor, but can confirm that you are not rich. Anyway, you have the money that you are going to spend for the next 20 days. It is somewhere in the bank account. That money is actually available to the rich, the super rich guys. They are going to borrow it, and overnight they are going to do so much with that money. They keep borrowing. They walk into banks and take billions. And they do business with those billions, return the money. Savings, they are not keen at it. But us guys, we have pensions. Because we are thinking of how 30 years from now will be, we are putting some money aside, Where is that money? It is with Britam. That money is with, yes, those guys who have shares in SAC companies. They have taken our money, so to speak, they have borrowed from us while we are saying that we are poor. So the poor are actually the lenders. That little, the good thing is that there are so many. So the 3,000 that you have in your account, the 2,000 that the other has, and so forth, accumulates into a lot of money that is available for these rich guys. So in the economy, we have that facilitation of flow of money so that it can be pulled together for the sake of economic growth. So it can be borrowed by those who need to borrow, because you will see that these guys who are borrowing are also producers, they are employers, and that is necessary. On the other side, if you look at it, there's also danger when the money is held in mattress accounts, when it is in crevices of buildings, when it is put in socks and other places, yeah? When the money is in that form, there are risks that are associated with that. You lose the money. You'd also lose the opportunity to have the small investment and benefit from it. You'll also lose from the advantages that the bank will give you in terms of payment system, the ability to transfer money with ease. You lose all that. So to facilitate flow of money within the economy, it is necessary to have these financial intermediaries. You need to look at it from the perspective of availing credit to those who need it, and also facilitating business. It is easier payment system when the money is within the financial intermediary. The next issue, which needs to be explained in some detail, is this statement, efficient allocation of funds. Efficient allocation of funds. When we talk about efficient allocation of funds, we raise the issue of information asymmetry. And from information asymmetry, we have the twin issues of adverse selection and moral hazard. I want you to take note of these terminologies. Information asymmetry. And from information asymmetry, we get twin issues of adverse selection and moral hazard. And now I can start explaining this, and then I'll be able to show you how it relates to the issue of efficient allocation of funds. Information asymmetry. Let me try to sketch on the space that is available to me. When you have a diagram that looks like this, and you can draw a mirror line over there, then you say it is asymmetric, is symmetrical. The two sides are the same, they look alike. Is one side is mirror of the other. But you can have a diagram that looks like this, whereby if you draw your mirror line across there, you see that one side is bigger, disproportionate to the other. This one we say is asymmetrical. You learn that one from so many disciplines, okay? You can also learn it, yes, in mathematics you had that. But those who do architectural stuff, or if you are building a house, you'll consider this. You not want to have a structure that looks asymmetrical. Even you borrow it from God's creation, look at your face, so symmetrical. If you split it right the middle, you see it is symmetrical. Asymmetry, the opposite of this. Information asymmetry. Information asymmetry. Asymmetrical information means that the information is not uniform on the two sides. And now we are talking about two parties to a transaction. When you bring two parties to a transaction, then it means that the information that is on one side should exactly be the same as the information on the other side. So if you are transacting, you're a lender, I'm a borrower. What you know about yourself should be exactly what I know about you. You should bring it to my attention exactly in that way. Now, what I know about myself, and myself, I know myself. Is it possible that you know myself the same way I know myself? Now, that is not what you are talking about. We are talking about details as pertaining to a transaction. All that I know as a party to the transaction concerning it, I should bring it to full attention. And in insurance, that is what we call the principle of utmost good faith. Okay, so that should happen. We should not have this kind of a scenario whereby one party has more information than the other. If one party to a transaction has more information than the other, then that one we call it information asymmetry, and that information asymmetry leads to the problems of adverse selection and moral hazard. Remember, we are contrasting the direct route and the indirect route. Let me continue explaining. Adverse selection. Adverse selection. What is this adverse selection? Another word for adverse would be wrong. So adverse selection would be something like wrong selection. So this is how we illustrate it. If you read textbooks in this area, they give an illustration like this. Today is on Saturday, and to make it worse, is on a public holiday. So let us put it this way. You got this nephew, and you'll find this illustration in textbooks. You have this nephew who is planning to gamble. You know this bet. They are betting a lot, and some of them will win some money. And once in a while, you hear someone is winning 300 million from a bet, if they're able to predict the results accurately, which rarely happens anyway. So you have this cousin of yours who wants to bet for a whole 10,000 shillings today in the evening, because football matches are being played. So that nephew comes to you to borrow 10,000 shillings. Focus on the indirect route, not indirect, the direct route, which is between borrower and lender. You are the lender of 10,000 shillings. Here's your nephew who wants 10,000 shillings. For what purpose? To go and bet. And you know the reality of betting, chances of losing 99%, there's that 1% chance that may win. Okay. You have only 10,000 shillings to lend. At the same time he's borrowing you 10,000 shillings, you got a niece also coming to borrow exact amount, 10,000 shillings. What is the niece going to do with the money? The niece has a fee balance, which must be cleared today. By the is today the deadline. Assume it was the deadline for registration. So these are 19-year-olds who have just joined university. Now this needs 10,000 shillings to clear fee balance. Now switch on your microphones to answer my question. Of these two parties, which one are you going to lend to? Have in mind that you have only 10,000 shillings. These parties are looking for exactly 10,000. So which party will you lend your money? Switch on your mic and mute.
I will lend my niece to clear the fee balance.
You lend your niece to clear your fee balance. Next person.
I would lend the betting game.
Why?
Different interest.
There are chances of return.
There are chances of return.
Yes.
But remember also is 1% chance. The chances of winning are like 99%. Next person, please help us. Annette, who would you lend the money to?
Oh, I'm the one who said I'd lend my niece.
Okay. Another person help us. You lend the money to who? To the beta or to the one who is going to pay school fees?
To the one
The
who
one
will pay
pay school fees.
fees.
The niece, eh?
Yes.
And now, except this one who has said will lend the money to the one who is betting, and I've never heard anyone reasoning like that. Looks like it's logical that you lend the money to this girl who is going to clear school fees. Now, at that point, the issue of information asymmetry kicks in. The guy is knowing very well that he's going to bet. He's coming to give you information of how he's going to use the funds. He'll not tell you that he's going to bet. He'll tell you that he's also going to pay school fees. So the information on one hand is, I'm going to bet. But what you have as the lender is, I'm going to pay fees. So you have two people who are placed at the same level because they are relatives. Niece, nephew, they are the same to you. Hoping there is no bias. But there'll be another issue, which brings about the adverse selection. This girl, what is she risking? What is her return? Her return is getting employment many, many years to come. So the level of motivation to borrow this money would actually be low, and do not be knowing how to return the money anyway. Because after you have paid fees, then what next? But this guy who is going to bet, he's even thinking that he's returned the money to you on Tuesday with 100,000 on top of it because he's going to win 200 million. That is motivating him so much. And that will make him to become so nagging to you. He'll persuade you, he'll tell you all this, he'll try whatever he can to get the money from you. But one thing he'll not tell you, and information asymmetry, he'll not tell you that he's going to bet with the money. He'll not tell you that. He'll tell you that he's going to pay fees. The niece has said he's going to pay fees. But this one, because of the return that is foreseen, is going to persist even more. Adverse selection, you are going to select the nephew. And what will happen immediately after, the nephew who is going to bet with the money is he'll lose the money and he'll disappear. So you will end up choosing the wrong person. Adverse selection. You will select the wrong person, adverse. And that will make it impossible for you to collect the debt and you lose the money. So that's how it works. Adverse selection, it happens before the transaction. The next term is moral hazard. Moral hazard. The word hazard also means risk. Moral risk. Moral risk, hazard, happens after the transaction. Yes, after the transaction, whereby the party engages in activity that are immoral from the lender's point of view. And it is part of information asymmetry because you will not know as the lender until it is too late. You will not know that this person is engaging in activities that are immoral from your perspective. All right? So what is going to happen because of this moral hazard? It happens after the transaction. The guy borrows money with a sober mind that is going to pay fees. He borrows 100,000 to come and pay KCA University. And you lend that money as a relative because you value education so much. Gives you a payment plan, all that. So what will happen on a weekend like this is going to do something. Back in the day, people were saying kutoa manyoya from that money. He doesn't have to pay exactly 100,000. He knows that. So he can decide to enjoy just 2,000 shillings. And he'll walk out, he'll go out with the money. You know, he has it in M-Pesa, he has it in the card. So I go to the club, hoping to spend 2,000. He spends 5,000. then I don't know what kind of spirit will attack him. On top of 5,000, spend another 5. By the time he knows it, he has spent 30,000 and now cannot actually do what he intended to do with the money. He drinks all that money. That is immoral from the lender's perspective. Now, that is so common with the direct channel. That is common with the direct channel. So, what do financial intermediaries have to do with this? Financial intermediaries have their own systems of getting the right information before a transaction. And you see how rigorous they are in the forms that they fill. And now we have to declare this and attach documents, pay slips, and guarantors. Put our social capital as stake. I saw, they also understand what they mean by social capital. Because if you are borrowing from your circle, they'll ask for name of your relative. And you give the name of your wife, you give the name of your mother. And because you don't want to mess up in the eyes of your spouse, then you got to behave when you have received the money. They'll also attach your employer. They want to know who is your employer, where do you bank, and so many details. Now they are doing this to eliminate that possibility of information asymmetry before the transaction, adverse selection, or after the transaction. They follow you after the transaction and they tell you this. Why are you borrowing the money? I'm going to pay fees. Where are you going to pay fees? To KCA University. Do this. You are not collecting from us money. You are going to collect a banker's check from us, check to KCA University, pay your fees. Or you are going to collect what? You are going to collect, we are going to pay the money directly to KCA University, that kind of thing. And that's why, to avoid this, you saw arguments that I was making last Saturday, actually. Hope you read my article. And I was arguing that banks should not be giving people mortgage because mortgages have not been working. Instead, they should give them money so that they construct houses. And one reason they not want to do that, to give people money to construct their houses, is how sure are they that people are going to construct the houses? And the issue of foreclosure, in case these guys default on payments, what they do, and especially if the guy did not actually construct the house, you cannot get anything to foreclose on. So banks are very keen on that issue of what happens after we have lent out the money and we are not paid. They must have systems of ensuring that if the money is misused, they can recover it. So that is how they ensure this efficient allocation of funds. The money, the loanable funds, are scarce. They don't want to allocate the money to every joker who is going to bet. They want to allocate the money where it should be allocated. And that way, they have the mechanism of eliminating this information asymmetry related problems. So that is the second point, efficient allocation of resources. If you got a question, can you go ahead and ask? Ask a question, I'm waiting. All right, allow me to proceed. Assistance in price discovery. A very critical role that is played by these financial intermediaries. Assistance in price discovery. What do we mean by this? How do we price securities? We talk about the markets of demand and supply, which determine the prices of commodities in the market. Demand and supply. So what is happening here is there is a better mechanism that does not allow those forces to operate freely. There's a way the market helps in setting these prices. First of all, we have the central bank or the federal bank in other countries. The central bank, in our case, Central Bank of Kenya, and by the way, students have the habit of when you give assignment and your exam would also be take away, they get the habit of Googling and give you stuff that is American. Give us American stuff where there's nothing Kenyan. But you cannot be talking about the Federal Reserve Bank, which is US, and you don't want to talk about the Central Bank of Kenya. Would excuse you if you are actually an American, but you must talk from the Kenyan perspective. Anyway, what does the central bank have to do with price discovery? The interest rate. The central bank will manipulate in a way, and through the fiscal policy of the government and the monetary policy, they'll be able to manipulate interest rate. And therefore, how credit will be accessible in the economy, how much the bank will pay for your deposits, how much the bank will charge you on your loan, has a lot to do with the central bank. And that actually affects many things in the economy, like even debentures, the debentures that are floated out there in the stock market would actually be so dependent on the interest rate that has been set by the central bank. So the central bank, to a very big extent, dictates the price of debentures. The central bank, by big extent, would even dictate the price of shares in the securities exchange. Because if the central bank, through what we call open market operations, decides to offer a good rate for treasury bills, and everyone rushes to buy treasury bill, it would mean that investors now don't have interest in buying shares whose return is flexible, not fixed, volatile. So investors will stop buying shares and go to buy treasury bills or treasury bonds. And that way, the central bank will even be influencing the price of shares. And you can see there's no direct association between the central bank and shares that are trading in the securities exchange, but there's that influence. The other way that financial intermediaries will assist us in price discovery or otherwise setting prices of these financial assets is as follows. They have experts that we call the fund managers. Fund managers are employed by unit trusts, are employed by bodies like pension schemes. You can imagine NSSF. There's no one who buys and sells shares in this country like NSSF because they have a lot of money. The savings that people are making, your 200 shillings and so forth, it accumulates to a lot of money. And what happens in that case is they are able to buy and sell shares. Now, who is doing this trade on their behalf? There are people who are known as the fund managers. And you'd find them also in insurance companies because they do the same thing. You'll find them in unit trusts, mutual funds, all those, they'll have these guys. Now, these guys can use their mathematical models to predict the share prices. And what they do is, using their models, they'll be able to compare the theoretical price of a share and the market price of the share. And when they find that the share is overpriced, what they do, when they find that they are holding onto a share that is overpriced, the next thing they'll do is offload it, sell it, release it. When they are doing this, they are not selling 1, 2, 3 shares. They are doing it in bulk. So they are going to like pour in the market so many shares when they are overloading. And with these many shares being availed in the market, they cause what? They cause an excess supply. This excess supply that they make in the market will cause the prices to reduce. Your economics tells you that excess supply will cause prices to do what? To reduce. And that is what will happen when they realize that they are holding onto a security that is overpriced, because they can determine whether a security is overpriced or underpriced. You see that? If they are holding, or rather, if they realize that out there in the market, there's a security that is underpriced, what they decide to do, because they know that naturally the price will adjust to the right amount. If they realize that a security is underpriced, according to their financial wisdom, they decide to buy it. They are not buying 1, 2, 3 shares, they are buying in bulk. They are moving volumes in the stock exchange. So they go there to buy and they place an order for so many shares. That will cause a lot of demand in the market. And with that high demand on the market, what will happen is it will cause the price to increase because demand has increased. And therefore, they have that as a mechanism that helps shares to retain their true value. So that is how they help people, or they help the markets to set prices. That is what we call assistance in price discovery. Money creation. Now, money creation is a magic that banks perform. Some magic. And when you go to the topic, commercial banks, then this money creation is handled in detail, and they look at the factors that limit banks' capacity to create money. Money creation is whereby banks have the capacity to create virtual money. There is the real money, which is in form of deposit, but there is virtual money, which is actually credit money. Remember, once again, we are contrasting the direct channel versus the indirect channel. The direct channel, they can only lend what is available. Like you have 10,000 shillings, is 10,000 shillings that you can borrow, that you can lend to the other party. But banks have the magic whereby they can multiply. There's a multiplier effect that Crowther talks about. Yeah? Multiply effect whereby they are able to multiply credit many times. And this is the magic. They say they create credit at the stroke of a pen out of nowhere. So a bank lends 1,000,000 shillings to A. And A's loan is cleared, 1,000,000. B comes borrowing, and the bank lends money to B, and it goes on to C. Now, there's one thing that will be happening here. When A borrows, does not withdraw the money immediately. It may take a week or some period before A withdraws the money from the bank. Now, before that money is withdrawn by A, it will be available to be loaned to B. And before B withdraws the money, it will be available to be withdrawn by C. So banks will require a small fraction of deposits to sell credit out of. So banks can multiply credit even to 7 times, as in if they have deposits of 1 billion, they have the capacity to loan 7 billion. Out of this magic of creating credit, one thing that should not happen is that the money should not leave the banking system. As long as it's within the banking system, then credit will be available many times more than the physical cash that is available. So they lend the money, and on loan they give another loan. And on a loan they give another loan, and they keep on giving loans on one assumption that these people who are borrowing the money will not come to withdraw the money at one go. So you'd have a lot of credit money available. You'll have a lot of money available, and in terms of credit, which is much more than what is actually within the economy. It is magic by the banks, and we say they have that magic of striking. So with this magic of creating credit, the economy would actually be growing, because there's that, should I say, it's a false sense of having money. Okay, you have money, but where's the money? It is with the bank. And what is the bank doing? The bank is continuing to lend that money over and over again. We call it credit creation. Very important for the economy, credit creation. So that is yet another important function of financial intermediary. I think I should pause at that point and ask you to like comment if you have a question. Any question? Any question? Are you there, Annette? Mukun?
Yeah.
Yes.
You are fine?
Well.
All right, let us proceed. Actually, I'm showing you the last slide. Don't worry if you have not taken lunch. If you have not taken lunch, we are still on the economic functions. Enhanced liquidity for the lender and price lessened risk for the ultimate lender. I can explain these points together. They are related. Enhanced liquidity for the lender. I'm saying, have this in mind. The direct channel, we are contrasting it with the indirect channel. In this direct channel, what happens is like this. If I come to you to borrow now, person to person, direct channel, from borrower to lender, or rather from lender to borrower, yes. If I come to you as a borrower to ask for 10,000 shillings, and I tell you I'm really suffering, I need 10,000 shillings. And you lend me out of mercy and all that, you lend me 10,000 shillings. And we agree that I give you back your money after 1 month. Do you know you are not supposed to talk to me even if you had what kind of a problem? If your child is hospitalized immediately after that, then you are not supposed to come back to me because we agreed. I'm paying you after 30 days. Wait for your 30 days to be off. Okay? You cannot say I'm refusing to pay you because that was the agreement. But look at the liquidity that we enjoy in the financial intermediaries as lenders. You have deposited your money there that you know, I need this money after 2 months. Christmas is when I need this money, and you have it in the bank. Should you need it after 2 days, you are free to walk into the bank, though back at your mind you needed it after 2 months, you walk to the bank and enjoy that liquidity. So you enjoy a lot of liquidity as a lender. But this liquidity is actually created for you. The bank has created the liquidity for you. Where have they lent the money? They have lent the money to a mortgager who is on a 20-year mortgage. They have lent the money to the government for 30 years. So if it was between you and the government, then the government will be telling you, wait for 30 years. You lose your liquidity completely as a lender. And that will mean you cannot lend. Because you cannot enjoy your liquidity, it will mean that you cannot lend. Even to lend for 2 days, it will be difficult because you cannot be sure of when that liquidity is required. It will mean that lending is actually impossible. And you cannot benefit from lending. The little interest that you get from your bank, you cannot enjoy because you have lost your liquidity when you lend your money. But we are left in perfect liquidity. We enjoy perfect liquidity as lenders, where the money is being lent over a very long time period, 20 years, 10 years. Yet on this other side, we are enjoying perfect liquidity. You see that? And we say banks lend long, but borrow short. They lend long and borrow short. You enjoy liquidity on one side, and on the other side, there's the opposite of that, a lot of liquidity associated with it. Banks know how to manage that process to ensure that the two conflicting parties with different time, needs can actually be brought together, and the banks will create assets that are attractive to either side. Because for you, you lend for 1 day, to the borrower wants to borrow for 1,000 days, 3 years plus. And that is made possible by the bank. So they give that liquidity. The next one I said is related is price lessened risk for the ultimate, or price risk lessened for the ultimate lender. The risk that you carry. What is the risk that if you have 100,000 shillings in your bank account that you lose it? Have you heard of anyone losing that kind of money recently? Like you deposited the money, went to the bank, and they told you it's not there? Rarely. Not unless someone has managed to hack your details and withdraw the money. It is not likely. There is no risk that you are carrying as lenders, as people who have put money within the banks, no risk. But where is the money? The bank, the money is with that mortgager who might refuse to pay the mortgage. So the risk profile on one side is very high. And on the other side, we have a party who cannot appreciate risk at all. The lender cannot accept risk, being the saver. The ultimate lender cannot appreciate risk. And the person who is borrowing the money is full of risk. How do you mediate? And we're talking about intermediation, like two parties that are totally different. They differ on this aspect of liquidity completely. They differ on this aspect of risk completely. Their risk profiles are totally conflicting. So how do they intermediate this aspect? their own magic, but it works. So you are able to enjoy literally where you did not plant, because where it has been planted, they are planted in the midst of thorns and other funny things and all manner of risks. But where you are coming to harvest is on a tabletop. Okay, now that is what happens. It is something that banks will do. It cannot happen without these financial intermediaries. So what is being intermediated here is the liquidity, because the two parties have different profiles. What is being intermediated here is the risk. The profiles are different. Improve diversification for the lender. Diversification. The principle of diversification is that you cannot put all your eggs in one basket. All right? So if you have like 1 billion shillings, what do you do with a billion? Buy land, buy shares in Safaricom, buy shares in Kakuzi, buy shares, I don't know where. Do so many things with a lot of, with that money, because it's quite much. What do you do with 10,000 shillings? Or if you are able to afford 10,000 shillings every month, what do you do with this 10,000? In terms of diversifying a portfolio is difficult. Otherwise we ask, when we say don't put all your eggs in one basket, what do you do if you have only one egg? This is what they do. And now I'm talking about unit trusts. Those funds, what they do is take your one egg, take another egg from another person, take some flour from whoever has 1 cup, and another person will provide a spoonful of sugar. Someone will provide an ounce of milk, and they'll put all these things together. Now they create a portfolio by combining these many things they have collected from many many people. They put them together, bake a cake, and then at the end of the year, they give you a piece of this cake. Therefore, from that piece of cake, you'd be able to enjoy some egg, some sugar, some milk, something from that small piece of cake, which was not available to you because you only had an egg. You benefit from portfolio diversification by going through financial intermediaries. You not have enjoyed portfolio diversification by yourself because you did not have enough to be diversified. But by putting it together, we call it pooling together all the resources from many people. They are able to bake that big cake, and at the end of the day, they share the cake into small pieces so that every person benefits and feels like they were able to bake a cake. So you can benefit from the well-performing real estate, benefit from Safaricom share, from Equity Bank share, and so many things. While your investment is very little, you get just a small bit of that. Economies of scale. Economies of scale in 2 aspects. Economies of scale in terms of is my next point, and I'm just about to conclude, my friends. Economies of scale in 2 ways. In terms of transaction costs, and secondly, in terms of research costs. Economies of scale in terms of transaction costs. Have that picture in your mind that there is a direct channel and indirect channel. And with that, let me talk about the transaction costs. If you wanted a loan of 100,000 shillings from a friend, which friend? Which one are you sure that has 100,000 shillings? You know what you'll have to do? or let's reduce it to 10,000 shillings. You needed 10,000 shillings. You need it so urgently Monday. So what you do is, now assuming there's no corona, you know, people are not meeting quite a lot because of corona. Now assuming that is not a problem to you, you'd imagine who could be having 10,000, yeah, and to think is your classmate. So you pick up your phone and call this classmate. Where are you? I'm in town. You are in town. I'm also in town. Can we meet? Where do we meet? We meet in some restaurant. We meet in Java. So go to Java. Because you are the one with the agenda, you are the one who requested for the meeting, it also follows that the bills are yours. So you take the cheapest thing in Java, which is a dawa. So you pay 500 shillings for 2 cups. And as you have your cup, you start explaining that, you know, I have a challenge. I need 10,000 shillings on Monday. I'll be able to refund it on Friday. And that guy tells you that he does not have 10,000 shillings and he leaves. So what do you do next? You look for another person and you get another person, same process, and you lose now another 500. You have lost 1,000. And in that way, you may end up losing a lot of money. Probably decide to pay a visit to your sister who is in another estate and you need to go with something. So you buy some bread and stuff to visit your sister to talk about the same thing over. And you are losing value. You are borrowing 10,000. In the process, you might lose 2,000. That is a transaction cost. If the amount was like 100,000, I tell you now it's not possible to give you 100,000 just like that. Let us do this. Let us register the agreement. Let's look for a lawyer. And to get a lawyer in town, pay 10,000 shillings just to sign off that agreement. And because you are so desperate, you'll be willing to receive 90 instead of 100 so that we can pay that agreement. That is a lot of cost that you'd have to incur. It's a transaction cost. With the direct channel, you'd incur such costs. But look at it this way. When you go to the bank, such costs are eliminated. Because banks' economies of scale means that they are dealing with volumes, very huge volumes. Those costs of negotiating the agreements are standardized. See the way the bank has done their loan agreement form, instead of drafting one for you and another one, each person they draft an agreement. There's just one standard form. So they paid a big legal fee, like 1,000,000 shillings, but the form that they have is enough for 1,000,000 for 1,000 customers. So they don't need to keep on making agreement. Whenever a customer comes, they sign an agreement. They negotiate and they call a lawyer for every customer. No, it does not happen that way. Because of the huge volume of transaction, they standardize the operations. They standardize the operations, and therefore you are able to pay very little fee for the transaction. The other issue is research costs. They are able to advise, and especially in the securities markets, because the experts sit there, they can conduct research and document their results, and you benefit from that. I remember sometimes back when I started working, things were not as tough. And for some reason, during Kibaki's time, the stock market, I think, was performing well, was stable. So we were buying shares, people were buying shares. I was seeing colleagues telling me, every month I've bought shares for 20,000, I've done this. But to be able to do this, you know, through all the months, you'll be reading the newspaper. Every morning you must look for the newspaper and go to that page that has share prices and read. And whenever there's information coming in concerning those companies who are so interested, you are following up. We were ever on the internet, and back then laptops were rare, so there used to be a few computers within the institution. We were rushing there to monitor the stock market. Now, that is research that we are doing for ourselves. And guess what? Most of the time we are getting it wrong. So it is a cost to do this research to be able to make a financial decision. And if it was difficult for us, and we are finance guys, then what happens to the farmer and to the athlete and to the other person over there who wants to make investment? They get advice from the research that has been done by the financial experts. They can tell you where to invest, where not to invest. They have done all the research for you. So that is another way we benefit from this research course. I'm just about to concluding in 5 minutes. Payment system. Financial intermediaries give us a means of making payments. Like the way you pay using M-Pesa, that is coming from a financial intermediary. The way you pay using your debit, your credit card, the way you pay using RTGS, the way you pay using all these manner of things. You are able to make payments. It's a payments system that has been created. That enhances trade. Without a payments system, business would actually be difficult. It is a very important function that we have from financial intermediaries, that they are able to allow payments. Back in the day, you would carry money in a paper and envelope, go and make payment. And therefore, you not need a financial intermediary. You can imagine these guys who buy cattle in the village, those brokers, wale wa ng'ombe. They don't, in their own trade, they might not need a financial intermediary so much. Even some of them are doing barter trade. Eh? Go to the market with a cow, exchange it for 5 goats, and it's fine. But some levels of business are impossible without a payments system. And when you think of doing trade across the border, and especially doing online trade, whereby you want to order for a book from America, you want to order for software from another country, how will you get that service without a payment system? Without Visa, how would you be able to do that? You see, it will become an impossibility. So a payments system actually is necessary and is provided by these financial intermediaries. I don't know, some people lost internet or what happened. We are only 3 remaining. Risk alleviation, this is simple, is actually insurance. Insurance is arguably the most important sector in finance. Of all financial institutions, the most important is insurance. And I tell you why. Without insurance, no airline would undertake the business of flying people from one place to another. How would you carry all these people if they are not insured? It will mean that in the event that there's a crash, that the entire airline would lose all its assets to compensate all those people. Those guys who perished the other year in Ethiopia, I have the list that they were getting in form of compensation was 31 million. And they were compensated. So, insurance is that important. There'll be no ship on our oceans. It means that all these cargo that we see around, no one would accept to ship it. You will not be seeing these vehicles on our roads. This risk alleviation, which is done by insurance, is very, very critical to business. So For that reason, we need that side of financial intermediation. They intermediate the aspect of risk. The risk that business people are not willing to take is undertaken by insurance, and that makes business possible. Monetary policy function, should be my final point. Monetary policy function, this is by the central bank. This is by the central bank. The central bank is able to manipulate the economy towards a desired direction by using its monetary policy. And there's a whole topic about monetary policy, how they manage the economic forces and how they manage the flow of money in the economy. The supply of credit by the banks is an important function that we get from the financial intermediaries, specifically from the central bank, and the central bank does it through the commercial banks. All right, I really wanted to share this bit. And my plan was, if you miss the class, I was going to record myself. I just teach the air and share it with your classmates. And it's good that I've been able to record this. So to those who missed, they'll get the recording. They have not missed entirely. They'll be able to listen to me. So that's the end of my presentation. I now want you to tell me if you have, oh, other people are still here, even some more came, we are 9. I was only seeing 3.